What is really happening in Pennsylvania? For years, this state was seen as boring in the best possible way. No wild boom, no brutal crash, just slow, predictable appreciation. The kind of place where you could buy a house, build a life, and trust that things wouldn't change overnight. That illusion is gone. Right now, across Pennsylvania, you're seeing something the talking heads still haven't fully admitted. Prices are falling in big cities and small towns. Inventory is stacking up in suburbs and college markets. Investors are quietly backing out. And in certain zip codes, we haven't even touched the bottom yet. From Philly's worn-down row homes to Erie's cold lakefront streets, a slow correction has turned into a visible decline. So what flipped? It's not one thing, it's the collision of several forces. High interest rates making homes unaffordable at 2021, 2022 prices. First-time buyers locked out and discouraged remote workers who once flooded in now moving on or cashing out, landlords selling off assets as rents. Plateau and costs explode, wage growth that never caught up with the pandemic price surge, and a broader economic slowdown that's hitting blue-collar and mid-income markets first. In this breakdown, we're going to walk through 10 Pennsylvania cities where home prices are collapsing in 2025, not just flickering, but structurally correcting. You'll see why each city is cracking, how deep the damage already is, what it really means if you're buying, holding, or getting out, and where, even inside the chaos, there are opportunities if you know what you're doing. This isn't for people who want comforting headlines. This is for men who want to see the field clearly, think in cycles, and position themselves with intention. Let's get into it. 10. Bethlehem. The safe bet losing its edge. Bethlehem used to be the definition of stable, old steel town roots, walkable downtown, close enough to New York and Philly to catch their overflow, but far enough to avoid their insanity. For a while, that formula worked perfectly. Remote workers moved in, prices climbed downtown, filled with coffee shops, bars, and revitalization energy. Investors saw it as the calm, dependable play in eastern Pennsylvania. But in 2025, that story has shifted. Home prices have slipped roughly 8 to 10% from early 2024 levels. Inventory is up 60% plus year over year, the biggest jump since around 2012. Older historic neighborhoods are flooded with for sale signs. Pandemic-era subdivisions are noticeably stuck on the market. What changed? The out-of-state buyer pipeline dried up. The New York and North Jersey money that once flowed in has slowed. Higher rates mean their buying power is weaker, and Bethlehem no longer feels cheap compared to what they can get elsewhere. Local incomes never caught up to 2021 pricing. You can't sustain big city prices on small city wages forever. At some point, math wins. Carrying costs rose. Property taxes, insurance, and maintenance on older homes are chewing up more cash. What once looked like charming now looks like expensive to maintain. Downtown still feels alive on a Friday night. The steel stacks still glow as a cultural landmark. But pull back from the tourist energy and you see the real story. More price cuts. Longer days on market investors quietly delisting and waiting for better conditions. Bethlehem isn't imploding, but the days of easy upside are over. If you're thinking of buying here, you're no longer stepping into a rising escalator. You're choosing a market in transition where patience matters more than hype. Chapter 9. Lancaster. The rural boom that came and went. Lancaster sold a dream during the pandemic. Space simplicity, historic charm, access to farmland, fresh food, and a slower pace of life. For 2 years, city professionals and remote workers poured in. Prices surged nearly 40%. Everyone convinced themselves this was the new forever. Then reality arrived. In 2025, home prices are down about 12% from the peak. In newer developments, some values are off by 15% or more. Young families and remote workers who bought at premium prices are now underwater. Rents are softening and vacancies are rising. The core issues. Remote work wasn't permanent for everyone. Many who came during 2021 had flexible arrangements that later tightened. As companies shifted back to hybrid or in-office, Lancaster became less practical. Wages are modest, costs are not. Local industries, Healthcare, small manufacturing, services aren't paying coastal salaries. But housing values tried to price like they were. Insurance and infrastructure risks are showing up. Aging systems, periodic flooding in certain areas, and rising insurance premiums are squeezing homeowners and landlords. So what does Lancaster look like now? Landlords offering first month free or reduced deposits. Sellers throwing in closing credits just to get a contract. Buyers sitting on the sidelines knowing every month might shave another percentage point off. The farms are still beautiful. The downtown market is still one of the best atmospheres in the state. But if you look past the charm, this is a market unwinding a bubble. For investors, the play is simple. You either wait for capitulation or you target distress with aggressive discounts. Paying 2022 logic in a 2025 reality is how you get buried. 8. Reading. When the investor wave reverses, Reading has always been a working-class town with a complicated relationship to growth. For years, its main advantage was simple. It was cheap. That pulled in commuters, investors, and anyone just trying to escape the higher costs of Philadelphia. During the pandemic, something new happened. Investors didn't just buy properties, they bought entire blocks. They turned Reading into a cash flow fantasy on spreadsheets and YouTube, thumbnails, now the bill is due. Home prices are down about 14% from their highs. Investor-owned properties are coming back to market in waves. Bank-owned listings are creeping up. The rental market is softening instead of tightening. What's driving it? Overconcentration of speculative capital. When too many investors buy not to live, but to flip or rent at inflated rates, the foundation becomes fragile. Once rents stop rising and appreciation stalls, the dominoes fall. Weak income base. Local wages were never strong enough to justify 2021 pricing. Reading doesn't have the high-income industries to support rapid, sustained appreciation. Infrastructure and quality of life drag. Aging systems, limited investment in core services, and spotty neighborhood revitalization make it hard to justify higher values long-term. Reading's strength was affordability, but higher taxes, rising insurance premiums, and more maintenance costs on old housing stock have eaten away that advantage. Now, owners who bought at the top can't exit cleanly. Landlords face higher costs with flat or falling rents. Buyers are treating the city with caution instead of excitement. For a disciplined investor, this is a place to cherry-pick distressed deals, not to buy everything because it's cheap. Cheap and undervalued are not the same thing. 7. Scranton, the remote work darling that faded. Scranton had its moment. For a brief window, it was the perfect pitch. Affordable houses, decent schools, commute, optional living. Small city with big heart brand, boosted by pop culture and political attention, people from New York, New Jersey, and Philly noticed. Values climbed, investors followed. Then 2024 rolled around and momentum died. In 2025, home prices are down, 13% plus from peak. Some multiplexes and investment properties are off even further. Flips are sitting, unsold vacancies are climbing. Why? Remote work demand was a sugar high. Scranton's growth was less about local fundamentals and more about external desperation. Once big city buyers stepped back, the air left the balloon. Stagnant job base, education, healthcare, and some service sectors keep the region afloat, but they aren't growing incomes aggressively. Manufacturing continues to decline. Youth flight. Young adults are leaving for bigger metro areas with more opportunity. Scranton's demographics don't favor long-term housing demand growth. The city still looks like something out of a postcard in certain pockets. Tree-lined streets, old architecture, a working-class backbone. But the reality, delinquencies are ticking up. Realtors are seeing fewer serious buyers. The narrative has shifted from undervalued gem to stalled out. If you're a buyer with a long horizon and realistic expectations, there are solid deals here. But if you're expecting 2022 style appreciation, you're chasing ghosts. 6. Erie, beauty can't pay the bills. Erie might be one of the most visually underrated cities in the state. Massive lake, Presque Isle, deep industrial roots. Naturally cinematic landscapes, but visuals don't balance spreadsheets. In 2025, home prices are down nearly 16% since the peak. Lakefront and dream homes have taken the hardest hits. Utility costs and weather-related expenses are punishing older housing stock. Insurance premiums tied to weather risk and lake effects are rising. What's going on? Tourism and local spending have cooled. When the broader economy slows, optional travel and seasonal spending are the first to fall. That trickles down into local businesses, incomes, and real estate demand. Aging housing meets rising costs, old homes, plus harsh winters, constant maintenance. With higher borrowing costs and inflation, many owners are squeezed. Flat job creation. Some healthcare, education, and small sector stability exists, but there isn't enough new economic engine to drive sustained housing demand. The result, properties staying listed across multiple seasons. Sellers chopping prices in steps instead of in one clean move. Investors quietly withdrawing rather than doubling down. Eerie is the kind of market where emotion says, this place is special. Numbers say, this place is risky. If you invest here, you need a very clear strategy. Deep discounts, long holding periods, conservative rent projections, and zero belief that the lake view alone will rescue bad fundamentals. 5. Allentown, the overextended comeback city. Allentown spent the last decade reinventing itself. Logistics hubs, warehouses, proximity to New York and New Jersey. Suburbs that promised more space and lower prices. The narrative was simple. Move here, live better, pay less. Between 2020 and 2022, that message went nuclear. Then the dust settled. By 2025, median prices are down about 11%, inventory is up 40% plus across Lehigh County suburban communities. Like Emmaus and Macungie are oversupplied. Warehousing and logistics growth has slowed as national spending cools. What broke? Industrial over-reliance. Allentown leaned heavily into logistics. When e-commerce slowed and companies tightened inventories, the hiring engine that fed housing demand sputtered. Too much building, too fast. Developers assumed pandemic demand was permanent. It wasn't. Now you've got projects chasing a shrinking pool of buyers. Shift in buyer psychology. Families aren't rushing to relocate at any cost. With higher rates and economic uncertainty, they're more cautious and less likely to jump just because something looks bigger and cheaper. Developers are reacting the way they always do at this stage. Incentives, upgrades, rate buydowns. Quietly canceling future phases. Allentown still has strong fundamentals, location, transport access, and existing population base. But the housing market is digesting years of overenthusiasm. The smart move now is not to buy the hype, but to wait for the truly motivated sellers, the ones who can't hold through the downturn. 4. York, the middle corridor. Losing its shine, York was supposed to be the strategic play between big hubs, between Harrisburg and Baltimore, close to major highways, cheaper than the big cities, attractive to commuters and families. For a time, it worked. Then 2025 hit. Home values are down. 15 to 18% in several areas. Bidding wars have been replaced by slow-moving listings. Out-of-state interest is way down. Local wages simply cannot support the old price levels. Pressure points. The external demand dried up. York's price surge depended heavily on buyers escaping more expensive cities. Once that wave paused, the local demand wasn't deep enough to keep prices elevated. Rising costs cut into the cheap living story. Higher property taxes, insurance, and everyday inflation have eroded York's affordability edge. Crime and confidence. Perception matters. Concerns about crime, combined with visible decline in some neighborhoods, have pushed families to keep looking or stay put. Builders have slowed projects, investors are liquidating where they can. Recent buyers are stuck in a gap between what they paid and what the market is now willing to recognize. York is the reminder that being in between doesn't guarantee safety. You can be positioned between two stronger economies and still lose if your local fundamentals can't stand on their own. 3. Harrisburg, when recession-proof, starts to bend. For a long time, Harrisburg had a simple advantage: government. Capitals tend to hold up better in downturns because government jobs don't disappear overnight. There's always some level of economic activity. Stability becomes the brand. But even that shield has limits. In 2025, home prices are down around 13%. East Harrisburg, Uptown, and even areas like Camp Hill are under pressure. Inventory has climbed, buyer activity has slowed sharply. Why? Government stabilizes but doesn't grow aggressively. Public sector jobs can keep the floor from collapsing, but they're rarely the driver of upside. When private sector hiring stalls, the market leans too heavily on one leg. Tax drag. Harrisburg's property tax and fee structure is a real weight. Some buyers are choosing to move just outside the core to avoid harsher long-term burdens. Private sector fatigue. The smaller logistics, services, and business support sectors that expanded during the pandemic have cooled. Without robust wage growth, demand can't keep pace with existing inventory. Riverfront developments still look good on brochures, the city still photographs well. But behind that, investors are reevaluating and homeowners are adjusting expectations. Harrisburg won't hit the kind of bottom you might see in more fragile cities, but the idea that it's untouchable is gone. If you buy here, you're purchasing for stability, not for quick upside, and you'd better run your tax and insurance numbers carefully. 2. Pittsburgh reinvention meets a hard ceiling. Pittsburgh reinvented itself more than once, from steel to medicine, universities, and tech. From smoke-filled skyline to polished glass and clean rivers. From Rust Belt relic to cool, livable city, for a long time, that narrative was justified. But no city stays invincible. In 2025, median home prices are down about 17% from highs. Trendy neighborhoods like Lawrenceville, Bloomfield, and parts of the South Side are stalling. Tech hiring has slowed, startups are trimming, and recruitment from other states is weaker. Office vacancies remain high downtown, hurting small businesses and nearby multifamily properties. The core issues. Innovation didn't guarantee immunity. Tech and startup ecosystems, once seen as bulletproof, showed they're just as vulnerable to tightening capital and higher interest rates. Investor saturation. Certain neighborhoods became playgrounds for flippers and short-term rental investors. When policies tightened and demand softened, the game flipped. Stagnant population growth. Pittsburgh's population is not exploding. When growth is modest and prices run ahead of incomes, correction is inevitable. There's still a lot to like about Pittsburgh: strong institutions, universities, hospitals, real neighborhoods with identity long-term potential. But if you zoom in on 2025, it's a market in reset mode. Developers are hesitating, investors are moving more cautiously. And buyers are in no rush. Pittsburgh will likely come back, it usually does. But if you enter now, assume a long horizon and slow recovery, not a quick rebound. 1. Philadelphia, the epicenter of Pennsylvania's housing breakdown. Philadelphia is the heavyweight, the largest city in the state, massive history, massive housing stock, massive problems. In 2025, it's also at the center of Pennsylvania's housing collapse. In parts of North and West Philly, prices are down 22%. Even hot areas like Fishtown and Northern Liberties are off. 12 to 15% crime perception is driving buyers away. Property taxes are hammering owners. Aging infrastructure and weak services are killing confidence. The damage comes from multiple directions. Confidence crisis. People don't just buy houses, they buy into a future. When residents feel less safe and less hopeful about schools, services, and stability, the bid disappears. Investor exhaustion. Flippers, small developers, Airbnb hosts, they all piled in during the low-rate era. Now, short-term rental regulations are tightening. Guests are down. Cash flow is weaker. Holding costs are up. Result: half-renovated homes, stalled projects, distressed sales, tax and policy pressure, high property taxes, slow permitting processes, unpredictable regulation. All of it makes repositioning or long-term investment harder to justify. The skyline still looks powerful at night. The historical core still feels heavy with meaning. But beneath that, sellers are stuck, buyers are cautious, and investors are calculating whether it's smarter to cut losses now or ride out another ugly cycle. Philadelphia is not hopeless, but in 2025, it is painfully mispriced relative to its problems. If you live here, the key is clarity. Don't overestimate your property's value. Be realistic about time to sell. Understand that waiting for 2021 prices to return may be wishful thinking. If you're an investor, you either go extremely targeted, block by block, deal by deal, with serious discounts, or you wait until the city addresses its structural issues, safety, taxes, and services. Until then, this is less city of brotherly love and more city of brutal reset. Where does Pennsylvania go from here? From steel towns to lakefront cities, farm markets to tech hubs, the pattern is the same. Pandemic gains built on cheap money, outside demand, and emotion. Now being unwound by high rates, stagnating wages, and fading confidence. Not every place in Pennsylvania is collapsing. Not every zip code is toxic. But the myth of safe, insulated, slow, and steady Pennsylvania housing has been shattered. If you're a man who owns property here, or plans to, you have three choices: ignore the cycle and hope it fixes itself. That's how you lose years to denial. Panic, sell blindly, and lock in maximum damage. That's how you sell low after you bought high. Study the shift, face reality, and act strategically. That's how you survive a downturn and position yourself for the next upcycle. Here's the framework. Don't assume your city is special because it once seemed stable. Run your numbers with today's costs, not yesterday's rates. If you're buying, demand real discounts, not just cosmetic price cuts. If you're holding, tighten your operations, financing, repairs, rents, reserves. If you're selling, be early, not last in line. Pennsylvania is not the end of this story, it's the preview. What you're seeing here, declines in mid-tier cities, corrections in suburban and college towns, investor retreat, is the pattern you'll see in many states as this recession deepens. You can pretend it's not happening, or you can use it. The market doesn't care either way.